Welcome back, everyone, to another episode on Living Your Greatness. This is your host, Ben Mummy. And the goal of the show is really simple: to learn from those who have mastered their craft at what they do. If you're new to my show, please be sure to hit the subscribe button. Today, I am joined again by Nicole Adshead-Bell, President and Director of Kupol Advisory Corp. So, Nikki, without further ado, welcome back to the show.
Hi, Ben. Thank you very much for having me. I'm thrilled to be a second timer.
Nikki, I kind of want to start today hopping right away about successful investing, because I think sometimes there's a mindset that I think more investors need to think about if they want to even ever have success. If we know how to proper position, it allows investors to then master the best of their circumstances. So what does that mean for you as an investor? And how are you positioning yourself right now to take advantage of the right opportunities?
Okay, I arguably do something that is maybe not everybody should do. I solely invest in mining. So I have very, very little diversification. And the reason I invest in mining is because that's the sector that I know the most about. And so it's easier for me to get up the learning curve, whether it's a specific company or a commodity. I have contacts in this sector. So I wouldn't necessarily advise people to be as focused as I am, but I think what is important, and maybe this is my approach, is understanding what you're investing in. If you don't have a basic understanding of what you're investing in, you don't know when to get in, you don't know when to get out. And actually getting out, selling, we always talk about investing, we never talk about selling. And the only time that you make money in investing is when you make a sell decision. And so for me, I think it's very easy to make the buy decision in many ways. It's very, very difficult to make the sell decision. And so when you go into a particular investment, it's thinking about, why did you invest? What kind of returns did you want to see? What kind of catalysts do you believe are going to drive share price performance? And that may be sector wide, or it may be company specific. And when those catalysts occur, make a decision. And is that decision to sell because you've reached those catalysts, or is that decision to keep holding on? And the biggest mistake we probably make as individual investors and as professional investors is greed. Well, it's gone up 20%, it may go up another 100%. And so it's been as objective and rigorous as possible as you're making those buy and sell decisions, and educating yourself. And that we live in this world where there is an abundance of information, and arguably too much information. And I think what happens with a lot of people, when you have a lot of information coming your way, it can sometimes paralyze your ability to make a decision. Infinite choice is something that I think that humans don't deal with as well. So it's understanding that you could spend days, weeks, months, years investigating and researching a particular topic, but at the end of the day, that has to result in something, and that has to result in a decision.
Right. And I think by understanding your thesis, no matter what space it is, you obviously talked about that well natural resources, but whatever it is, you really need to know what you're doing before you even make that decision, right? Because there is risk.
Yes.
So a question I'm curious to ask is, you talked about when to buy and when to sell in terms of like having that in your mind. But if we think about rules, because it's really easy for us to get emotional, especially because there's so much out there, like you said, right? So many things to invest in, and real information and fake information. So, it can be overwhelming for investors. So, Nikki, I believe that rules could help investors turn, their desired behavior into their default behavior. So what are some investing rules that you stand by?
Number one, when I'm making an investment decision, the thing that I try to do and step back, and this is about bringing a layer of objectivity into that decision-making process, is say, where are we in the commodity cycle? And every single specific commodity will be at different points in the cycle. And the reason I want to step back and go, where are we in the commodity cycle? If you're in the part of this commodity cycle where the underlying commodity is going down, no matter what you do, your investments, if you're investing in direct equity, they're likely to go down unless they generate outsized alpha. And that would normally be in our sector in the form of a drill result. So a rising tide floats all boats, but a withdrawing tide, I'm getting the saying wrong, it sinks all boats. So And the reason I look at where we are in the commodity cycle is that both investors and companies indulge in very, very predictable behavior, depending where you are in the cycle. Now, this is not my quote, it's someone else's, and it's the four most dangerous words in investing are this time it's different. It's never, ever, ever, ever different. Now, if you understand that and accept that, that can go a long way towards increasing your chances of success in investing, specifically in natural resources. So number one, try and understand where you are in the commodity cycle. And then number two, invest accordingly. And so there's different patterns of behavior. And I have some things online and I've given a lot of talks about this, is how do you figure out where you are in the investing in the commodity cycle? And this is based on an idea of an Australian fund. They call it their mining clock. And so I've adapted that to how I think about the world. And so you want to sit back and go, what are companies doing and what are investors doing as a whole? And that dictates for me how I position myself.
That's very helpful. But if we now think about, okay, commodities as well as precious metals, the whole space, right? And
Right.
you obviously talked about the mining clock, right? In terms of the cycle. I understand right now that you are very bullish on both precious metals as well as commodities. So why do you see this right now, a once in a lifetime opportunity for millennial investors like myself?
So for me, gold is the toughest one. And gold is, we could spend a day talking about gold, because gold, it's a store of value. It doesn't necessarily behave like a traditional commodity. Almost all gold that has ever been mined in the world is still in existence today. So it's got very, very many unique qualities, and it's a store of value. And arguably gold should be foremost in investors' minds and in your generation, as Bitcoin is, and it isn't, because it has many of the same parallels. And one of the reasons that it isn't, or the key reason, is that we as an industry have done a very, very poor job of promulgating the investment thesis of that underlying commodity. And obviously we've had an extraordinary rise in the gold price. We're at record prices, but we have yet to see the underlying equities that are exposed to that gold price re-rate accordingly. I mean, if you had said back in the early 2000s that we would be at $2,300 gold by 2024, people would have thought you were smoking crack, and you would have been considered to be a nutter. So there is gold's a fascinating, interesting commodity that we could devote a lot of time talking about. What I do want to focus on is a commodity, to me, that's much, much easier to explain and to understand and to viscerally embrace the investment thesis behind that. And for me, that's copper. So I will say I'm arguably very biased. I have drunk the Kool-Aid on copper. So copper, we talk about critical commodities, and everybody's heard about it with the move to net zero, decarbonization, ensuring that we reduce our carbon footprint. And you hear about these commodities that are perhaps considered a bit more sexy. So lithium, probably most of your audience has heard about lithium and lithium batteries. And people are talking about critical commodities, but for me, copper is the critical commodity. Without copper, there's no lithium batteries. Without copper, there's no electrical networks. Without copper, there is basically the world as we know it today ceases to exist. And so this commodity, which is the base of all critical commodities, I think we're in this perfect storm of supply demand. And the reason I think this is that we have copper supply, which is the critical commodity. And you can Google this. Anybody can look at this. This is not a secret. And we'll talk a little bit about why the price hasn't responded in the way that I think it should be responding in a moment. There is this universally accepted thesis that primary copper supply is going down. And I would say when all the, and in everybody's supply models, this is not a controversial statement to make. From 2025, primary copper supply is going down at a time where you're starting to see an increase in demand that's around the net zero thematic. So if you have your primary input going down and demand remaining stable or even increasing, the underlying price has to increase. It has to. And I would look to lithium actually as where I think that copper can go. So we saw at the beginning of the build out into the EV side of things, people suddenly went, we need lithium and we need more of it. And you had an 11 times increase. Think about that for a second. 11 times increase in underlying lithium price. And that did what it should do. That incentivized new supply. Now with copper, we are in a situation where the average grade of all copper mines globally is going down. So that, what that means when I say grade, all that means, to think about it, is that the cost of producing that unit of copper is going up. So if that's the case, the copper price has to go up to incentivize new supply. Now, mines and copper, every single commodity, it's not a widget factory. You just can't call up, like Amazon could call up a distributor of XYZ. These products are really popular. We would like to see more of them. Can we have more of them? And within 2 or 3 days, I would have more of them. Mining is not like that. There is a very, very, very big timeline. It's very similar to biotech, from discovery through to production. And in fact, S&P Market Intelligence they do really, really good research, and there's some stuff that's free. So if you go onto the website and have a look, the average timeline from discovery to production globally now is 15.7 years. So if you want to bring new supply on quickly in mining, you simply cannot do it. So what does that do? That increases the unit price of copper, and it therefore will increase the price of the equities that are exposed to that commodity. So that's my thesis. And so I think copper provides an unparalleled opportunity because there is no argument about the basic underlying thesis, none. And we are not seeing new copper mines being built. In fact, we're seeing the opposite. We're seeing the CEO of the second largest copper producer in the world, Glencore, come out and say, we will not bring on new production until the market is screaming for it. And that screaming for it will be reflected in the underlying commodity price. And so for companies to make a decision to invest in new mines or expand existing ones, they need to be confident that there's a return. We've been in a highly inflationary environment. CEOs aren't being rewarded for taking on risk. And so what does that mean? The underlying commodity price has to increase. And in my opinion, it has to increase materially. And so I've been saying the same thing for 3 years. I think we're now trading in the fours. I think it has to go to at least $6 to $8 for anybody any major organizations to make material decisions about investing in new supply. And so what's the other leading indicators as to why it has to go up? We have record low, what we in the industry call TCRCs. And that means when you produce copper, most copper production, it's basically in the form of a flour. And so you need to do extra processing of that material to produce copper metal. It's copper concentrate. So treatment charges, so the refiners that refine that metal and refine that powder and produce a metal, this is called TCRCs, or treatment and refining charges. Now, when copper concentrate is abundant, treatment and refining charges go up because the organizations that need that powder, that need that concentrate, they are in a position to pick and choose. Now, when TCRCs go down, and they are at absolutely record lows, that's because access to that concentrate is very difficult. So we have record low TCRCs, we have flatlining to declining production, we have no new mines being built, we have copper price starting to move, we are starting to see M&A activity in the copper space. So we had BHP acquire Oz Minerals. We have had BHP make an announcement of their intention to acquire Anglo American, and that's been rebuffed. Now Glencore has come into the mix. So you're starting to see leading indicators, and this is back to where we are in the commodity cycle. A sign of the beginning of a bull market is what I would call low risk M&A, and that is like getting with like. So producers buying producers. So you're starting to finally see the people who should understand this sector the best, the leaders of the largest diversified miners in the world, waking up to the fact that we are probably, in my opinion, at the beginning of a massive increase in the copper price. And so how do you best get exposed to that?
I appreciate that explanation. But one thing that I can't help but think about is like, Okay, a thesis does take time to play out, right? And
It does.
you kind of brought up the whole commodity cycle and how that's important. But when does investor, psychology come into play for this?
Unfortunately, most investors will start investing after the commodity price and equities have gone up plus 50 to 100%. So if you want to be exposed as an early to the beginnings of a bull market, that's a risk because nobody can predict the bottom and nobody can predict the top. If anybody says that to you, they're lying. It's impossible to do. What you can do, in my opinion, is go, we're hovering around the bottom. I think that we've got green shoots that the commodity price is going to move and the equity should follow. But you have to be prepared to take some downside risk in the meantime. So it really depends on your risk appetite. I mean, if you are investing in high risk equities, and don't get me wrong, the juniors are very, very, very high risk. You need to be prepared to lose money. And if you're not prepared to lose money, you shouldn't be investing in it. So there is the potential for outsized returns, but there's also the potential for very, very material losses. And so for me, as I look around the sector, I'm willing to take that risk. I'm willing, and I can hold. So I've been invested in some companies I've had this thesis for the last 3 years. I've been talking about it publicly since 2022, saying I think copper has to go to $6 to $8. And now I'm starting to see other people who are talking about copper say the same thing. I was out there standing alone for a little while, and I was willing to take that risk. And so if you look at equity prices in 2022 to now, they are flat, if not slightly down. So if you're prepared to take risk, I think now is a very, very interesting time. There's all these indicators. I don't see anything curtailing my thesis, except maybe a nuclear war. And if that occurs, we've got a lot bigger things to worry about than underlying equity performance. So, but if you are unprepared to take that risk, what you want to see is what we're starting to see now. So copper prices started to move. Equity prices have started to move. We're starting to see behavior, absolutely classic behavior at the beginning of a bull market. So I think the downside risk now is lower than what it was 2-3 years ago.
I'm curious to ask you, some investors that are maybe listening right now might be like, okay, Nikki, we understand the thesis. We are seriously interested in it, but there still can be some short-term risk, not long-term risk, but short-term.
Absolutely.
And you just talked about risk, which is great because it's always important for any investor to always think about risk before even making a decision. So what are potential short-term risks that you think investors need to know about before making this investment decision?
I think it depends on what kind of company that you're invested in. So developers if there's a short-term price correction, those companies that have the most leverage will correct the most. And those that have the least leverage will correct the least. So if you like copper and you're thinking about investing, the least risk approach is to invest into producers, and producers that have a healthy balance sheet, that don't have any big capital outlays, that are well-managed businesses. So those will move with the copper price. They'll go up when the copper price goes up. However, they won't go up as much as a company that has a lot more leverage. And by that, I mean they've got more debt on the balance sheet, they're a higher cost operator, etc. So you'll have exposure, but it will be lower risk exposure. And so how I look at the universe, there's a risk matrix. And if you want the highest potential return, you're taking on the highest risk. And the highest risk will be with the juniors. So if you want to have a diversified portfolio, you want to be exposed to producers, the large diversified producers, then the copper producers that have got all the things that I talked about, multiple assets that are producing copper and generating free cash a day, that are healthy balance sheet. And then you start going down the food chain. So you start looking at the developers and the explorers. And look, in a bull market, you do not have to be selective. In a bull market, whatever you buy, it will go up. that's what a bull market is. That's the insanity and the craziness and the wonderfulness of a bull market. You just also have to sell.
Absolutely. And I think a bull market doesn't always mean we have brains, right? I know Rick Rule talks about that a lot. But something that I am curious to ask is, what is your opinion on selecting whether it is a major or a junior, mining company? How do we actually find a company that is of good value rather than, oh, it is a cheap stock? So how do we differentiate, the difference between value and price cheapness?
That's a very, very good point, and something that it can be very, very difficult to do. So you can have a company that's very cheap. It's very undervalued on all metrics. It's got a project that has got economics around it. It might be trading at a massive discount to its supportable underlying value. Often those can be value traps though, because if something is really cheap or undervalued, you need a catalyst for that value to start being expressed. And often that comes down to management. So management, you need management that's capable of extracting value and expressing that value to its audience. So you can have a good project that doesn't have a good value and will never ever have a good value, and that's management. You can have a crap project that is overpriced, but you have a management team that's able to generate interest and investor value, the interest in the share price. So share price performance is a very, very different thing to asset quality. And I would argue that technical people like myself, sometimes we will miss out on very good share price performance companies because we look at them and go, that asset is a piece of crap, never going to work. So we're too focused on the technical fundamentals versus sitting back and going, hang on a minute, this is a team that knows how to sell a story. So I think you have to understand, and you can make a lot of money out of those seller story management teams. You just have to also be willing to sell, because ultimately truth comes out. In our sector, it can take years, but ultimately truth comes out. And so I think technical people have an advantage and a disadvantage in our sector, because we are better able to understand what is real, but we're competing against 99.9% of investors who don't have that basis of knowledge. And so in some ways, people who are very, very overly focused on the technical side will definitely underperform in the short term. I think the challenge that investors face with our sector, and particularly the junior end, is there's literally thousands of companies. And so how do you wade through and distill those potential of thousands of companies into the 10 maybe that you might want to be exposed to? And you also have to be realistic. If you're investing, you need to be following and tracking those companies. And the biggest mistakes I've made, and I've made some really big ones, like holding a company down through to bankruptcy, is because of lack of attention. So when you own something, you need to be willing to look at it and monitor it. And so if you have 50 positions, that's much, much harder to do than if you have 10. So as you're starting to look at this sector, for example, number one, just trying to start maybe following people that are educated in the sector, but are also speaking from a point of objectivity, that aren't just pushing the stocks that they're exposed to or they're getting paid to talk about. So we've got a lot of influencers in our sector. Some are better than others. So just starting to see how people are looking at and talking at companies before you make those decisions, I think, is really important. And then also reaching out directly to companies. This is a very unusual sector where management teams are available. They're available to investors. There's lots of conferences. There's so much online product. There's a lot of sources that you can draw from, but again, that takes effort and work. And in my experience, lots of investors, they want to have a guru. Institutional investors are the same. They don't necessarily want to put the time and effort into themselves. I would argue that how you increase your chances of success is you have to put time and effort into it. If you're going to go out and buy a new TV, the average person probably spends 2 to 3 hours at least figuring out what kind of TV they want to buy. And then think about if you're going to buy a car, which is a much bigger investment, and how much time and effort you'd put into researching that. And then it comes to buying an equity, and you have people they go and buy something based on the fact that their mate said they like it, or some bloke on Twitter said that they like it. So you need to understand what it is that you're buying.
And if we think about mentorship, which you kind of just played on at the end there, who is someone that you really value in the space that you really learn from?
I mean, Rick Rule is the person that first comes to mind, because when I first came to Canada, I mean, I'm a geologist originally and knew nothing about the business side of the business, which is actually one of the great failings of educating geologists. And when I came to Canada, I was working for a junior, and Rick Rule and Brent Cook at the time was working for Rick, reached out to that junior to better understand the story, and I just happened to pick up the phone. And so working for a junior gave me a very, very good understanding of the in the trenches behavior of companies. And so as a junior, you constantly have to access money. So you're constantly having to raise money. So you're trying to figure out how to best communicate to a general audience. And so Rick, I know that you've interviewed him. He is someone who is very, very gracious in terms of the amount of time he's willing to spend with people and helping them understand about the sector. And so he is probably one of the best promoters that I've ever seen, one of the best communicators. He and Friedland still, I don't think there's anybody that's really caught up to either Rick or Robert in their ability to message something very, very, very effectively. And so I feel like I've learned a huge amount from Rick, obviously, Brent, Joe Mazumdar with his exploration insights. Joe's a very, very, very honorable guy. He doesn't get paid by companies to talk about about them. He gets paid by his subscribers. And so his motivations will be very different to someone who is talking about a company because they're getting paid to talk about a company. I look at a whole bunch of different news feeds. There's some great junior mining network groups like that will summarize press releases for you. I suppose I have it's a little bit different for me. I have a big content network in this sector. So if I want to understand about a person or a company, maybe I've done some legwork, there's normally someone that I can also ring up and say, what do you know about this asset? Or what do you think of this management team? So it's a little bit easier for me to get to that point of knowledge more quickly than the average investor. So it is really just starting to troll through information. But I agree, it's really tough. It's how do you find those names? And sometimes the names that get heavily promoted are maybe not the best companies. So it's how do you distill through the morass to come up with those 5, 10, 15 companies that you may want to be exposed to. It's not easy.
What are some investing principles that you stand by that you think more investors need to be aware about?
Know where you are in the cycle as it relates to commodities. Be willing to lose your money, because you will. All of us do. Try and remain objective. So you'll buy a company for XYZ and then the stock moves, and it moves for none of the reasons that you bought it. So I think when you buy something, you should write down why you bought it, because it's really difficult for us to remember. It's why witness testimony is so unreliable. We change a narrative over time so that it makes us feel good. So I think to be honest as to why you bought it, and if it went up, but for none of the reasons that you bought it, then you have to say, okay, if that thesis is going to play out, I've had a win, sell. Selling, you have to sell. You have to be willing to sell. And that's the bit that we all get wrong. I mean, there are people that I know that were worth millions and millions in the last big bull market in 2010, 2011, where their positions were up 200, 300%, and they didn't sell. They rode it the whole way down. And what happens is when something peaks and starts to go down, it's human nature to go, oh, but it might go up again. You have to have the imagination to go, yeah, and it might go down another 90%. And that's what happened from the peak at 2010 to 2015. The GDX and the GDXJ on the gold sector, which are the ETFs that represent large companies and smaller companies, those two indices, those two ETFs were down 80 and 85%. So you have to have the imagination to know how far, and selling something not at the top, but you're selling something if you've made money, you've made money. That's an awesome outcome. Selling something when you're down 10% versus being down 80%, that's also a great outcome. So you just have to understand that you don't make money till you sell. And that's the bit that we don't focus enough on, in my opinion.
And I also think that that is such simple advice, but it's hard because we are all so emotional as humans, right? So one final question that I want to ask you that I think is really important for investors to pay attention to is, if we think of the great investors, right, like Charlie Munger, right? And, he had a speech in 1995, on the psychology of human misjudgment, right?
Yeah.
Where he explains that behavior economics can be applied to not just business, but also investing in life. And so question I'm curious to ask is, what are mental models from your investing toolkit that you use to make more intelligent investment decisions?
I'm constantly trying to step back and be objective about my behavior. And that's a very, very, very difficult thing to do, because we are emotional, irrational beings. That's what our species is. And so being able to sit back and also understand your own inherent biases towards investing. I have an inherent bias to buy cheap. I want to buy deeply undervalued stocks, and then they don't move. And so I make that mistake time and time again. So it's being aware of your inherent behavior. And in some ways, my husband and I talk about this. It's almost investing with someone else who has different opposite biases to you I actually think that would be a very strong partnership. So someone, if you're always someone, you make the buy decision, for example, and they make the sell decision. You separate those two things out. So investing with other people where you can bounce ideas and people come from, that's a good thing, in my opinion. So for me, I suppose that the key ingredient is trying to constantly step back and go, am I being objective enough about the decision that I'm making? And if I'm not, I need to change. So it's discipline, and also discipline in following what you've invested in. The discipline of being objective and then tracking. People tend to be pretty lazy. We want quick reward. We don't necessarily want to focus. And when things are going up, we feel happy. When things start behaving negative, another human behavior is to kind of stick your head in the sand and pretend it isn't happening. So back to your point about Charlie Munger and Warren Buffett, like Buffett said that he never invested in something that he didn't understand. And it's why they weren't exposed to the real estate collapse. They never invested in the products, the derivatives of this assumption that house prices would rise into infinity. So being educated and disciplined, and for me, discipline is probably the most important thing. And the absolute biggest mistakes I've made, and I have made many, is that I was not being disciplined enough in terms of selling and monitoring what it was that I had bought, because something else got distracted. I was distracted by something else. And that was normally if I'd made some big positions and then I was working full time and was very, very busy. And also it was a bit more difficult to trade, because if you're working for a fund, you need permission every time you buy and sell something. Those losses were absolutely due to a lack of discipline. And the two things that I speak about ad nauseum, which is selling and monitoring what it is that you have.
I'm totally in agreement with discipline. I think also having good habits or investing rules, kind of like I shared before, I think is very important for investors to dial more into. Before we end off today's conversation, obviously I want to thank you for being here, but are there any last words that you want to leave with either investors or CEOs or other people that are investing in this space?
the biggest challenge that our industry faces, no matter what commodities you are exposed to, is one of reputation. And that is because people don't understand where their stuff comes from. And now that's not their fault, that's ours, because we as an industry have done an unbelievably poor job of communicating that commodities, what we do, what we produce, that is basics of life as we know it. Without mining, life as we know it ceases to exist. And so I suppose my rallying cry to whether it's CEOs of large companies, the leaders of our industry, whether it's people who are investing in the sector, whether it's those that are working for companies, is to start being proactive about educating as much as you can what it is that we do. Because without mining, everything goes. And my sister said this best. She said that you can choose to be a vegan, but you can't choose not to be associated with the products of mining. And so some of the issues that we see in our sector with government, with regulations, with mines being shut down, such as Cobre Panama in Panama, with mines not being permitted, with the increased timelines, is that politicians and regulators know that there will not be a voter backlash if they come down hard on mining. And you come down too hard on mining, what you see is what we're starting to see, which is underinvestment into critical commodities that we need for not only to survive, and a baseline is what we know today, but to fulfill elements like net zero. And so for me, education and getting people to understand where their stuff comes from. And I think you're doing a fantastic job of helping with that, Ben. And so I hope that you continue to do what you're doing. It's very, very valuable for all of us in this sector.
Thank you so much, Nikki. Where could my listeners go to follow your work?
LinkedIn, I have a website, just Google Capella Advisory. I do videos, so if you YouTube, well, not that I do them, but I suppose interviews and podcasts with people like yourself or with Kitco or with other groups. And so that will come out, and yeah, feel free to reach out to me. I can be kind of bad at responding. That's one of my New Year's resolutions, is to get better. So I'm attempting to be better at responding to incoming communication.
Well, thank you so much for your time today, Nikki.
Thanks a lot, Ben.